We are joined from Hong Kong by Chief Economist for Greater China at Mizuho Securities, Shen Jianguang. Shen, thank you very much for being with us. First of all, you expected imports to grow by 17% year-on-year in December. We only got growth of 11.8%.
Yeah.
Does that mean that the slowdown in China is much more severe than you thought?
Yeah, I think there's also some other reasons, like the slowdown in the global economy and the lower commodity price. I think that's probably also reason behind the much lower import number. But as I mentioned earlier, that this Chinese tightening, especially the monetary tightening, has gone too far in third and fourth quarter last year. So I think the very clear, visible slowdown in the Chinese economy, especially in the industry side, even though the consumption appear to be maintain a pretty good pace.
Now, does that mean that this weak data is going to provoke an immediate policy response from the Chinese government? Could we get something imminently?
I think that's already underway. So if you see that in the past few days, China held this fourth national financial conference. That's actually once in every 5-year time. Normally, this kind of conference, Chinese policymakers discussed about the long-term issue, but this time they emphasize on short-term slowdown and the need to loosen monetary policy, stimulate the economy, and to stimulate this, to boost stock market confidence. So I think it's already, the message has been taken already. So the Chinese policymakers will do more loosening in the weeks ahead.
So Geithner's in Beijing today. He's going to want to talk about the yuan, but does this data today give him more ammunition to call for a bigger increase in the yuan?
I think actually if you look at the renminbi yuan exchange rates, the market, especially in the Hong Kong offshore markets, it's a pretty free market. There is actually a depreciation pressure for the Chinese currency. It's the government that intervened in the market to support the Chinese currency. So I think regarding the currency issue, it will be a less, this contagious issue. And
it's
also, if you look, yes?
Interesting to hear you say it's a pretty free market, since we know that exchange rate is fixed by the Chinese government. You're also calling for it to be at 6 Chinese yuan to the dollar by the end of 2012, which would mean that it weakens.
No, what I mean is the Hong Kong offshore market, that's pretty free. So there are two markets, onshore market, exchange rate market. So the central bank has a lot of power to intervene. But in the Hong Kong offshore market, it's mainly determined by the participants, market participants. Actually, if you look at these two market movement, in Hong Kong, actually, the investors are actually expecting a weaker currency than the onshore market. So that's why there's about the fear of Chinese hard landing. So there's some capital outflow from China in recent weeks. So that's why the signals by the Chinese government is that we don't want to have a depreciating currency at this moment. So they intervene to support in the onshore market. So, but if you look at the whole year trade surplus, it's still only a little over 150 billion. So that's a little something around 2% of GDP. That's down from 7% of GDP in 2007.
So it's moving in the right direction. Shen Jianguang, thank you very much for being with us. Chief Economist for Greater China at Mizuho Securities Asia. Thanks so much.